Good morning. Welcome to Stock Market Today. It's Thursday, January 16th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where you can follow along with this show, as well as get daily stock ideas for you to consider. Hits your inbox every trading day before the market opens. So U.S. equities were mostly higher in Wednesday's trading as the U.S. and China signed phase one of the trade deal and earnings reports continued. Defensive sectors and healthcare led. Energy, financials, and consumer discretionary did finish lower on the day. Treasuries were stronger across the curve. The dollar was weaker versus the yen and the euro. Gold finished up 60 basis points, and WTI crude settled down 70 basis points, though off the worst levels of the day. And as we get to the desk this morning, earnings reports continue, and S&P futures are up 30 basis points, extending recent gains. Asian markets were mixed overnight, and European markets are slightly weaker here this morning. Treasuries are trading flat. The dollar is stronger against the yen and slightly weaker against the euro. Gold is up 10 basis points, and WTI crude is up 40 basis points to get us going on a Thursday morning. Taking a look at the chart of the S&P 500, not a lot different to say. Record highs with the phase one trade deal in the books. Near-term support remains in that 3150 to 3200 range, and we are still looking for resistance levels to form, right? By definition, with the markets at all-time highs, there is not price-based resistance. The RSI remains in bullish ranges, actually pumping back into overbought territory above 70 if you take the traditional definition. But what I'm looking at is the fact that we're in a strong uptrend and the indicator has shifted to the upper end of the range and is routinely becoming overbought. To me, that is a momentum confirmation to the price trend that we are seeing. And now add to that bullish Chaikin money flow readings and you kind of get the point, right? Indicators are lining up with the price trend, price continuing to work higher. We've laid out support levels, waiting for price-based resistance levels to form, continue to focus on leading areas of the market. And just as importantly, what we're going to spend some time on today, avoid the lagging areas of the market, right? It doesn't feel like a bull market if you've been overweight energy. We'll take a look a little bit later in the show. Let's look at our market in a minute now. What are we writing about? In our note today to Chaikin Analytics clients, well, U.S. stocks trade, the U.S. markets trade at near record levels as phase one deal is signed. Global stocks are rising with their U.S. peers. Pharma breaks to new highs and is leading the broader market. Breadth metrics continue to confirm the equity rally, and futures, as I said, do point to a higher open here today. Now, taking a look at the major indices on the day and from a power bar perspective, the Dow added 40 basis points or so. 5 bulls to 6 bears there. The S&P 500, 133 bulls to 22 bears after adding 22 basis points yesterday. The NASDAQ was kind of flat, up 4 basis points, but 27 to 5 bulls to bears in that group. Small caps outperformed on the day. 666 bulls to 212 bears. Bonds uptick sending yields lower, and that helped the utilities group. Utilities were leadership yesterday, up 1.4%. 10 bullish or very bullish stocks in the utilities for 0 bearish or very bearish stocks. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major markets across the board are mixed as the Dow is skewed slightly to the bearish side of the coin. Taking a look at our stock of the day today, we're going to change it up. I'm going to give you the stock that I was talking about in my note to Chaikin Analytics clients today, and it's INVA. Stock has a very bullish Chaikin Power Gauge rating, and you can see why as we break down the different factors. The financials are bullish. Earnings are very bullish. The technicals are bullish. And the experts, they are middle of the road. But when we roll up the 20 factors, 5 in each of these 4 categories, we come out with our very bullish rating. Taking the analysis to the chart now, very bullish stock is a strong trend above the rising long-term trend line and is in a strong industry group. Pharmaceuticals are a strong group. We'll take a look at that chart a little bit later on in the show. Take a look here. Power gauge rating turned bullish back in the October-November timeframe, and then in early December, INVA began to outperform the market. So market and model are in agreement. Money flow has been persistently bullish since October, right around the time that the rating changed, and the stock is oversold. And interestingly, the overbought oversold indicator is moving higher within that oversold position. So to me, that sets up an ideal situation to be looking at Viva as a bullish idea. We have a leading stock in a leading area of the market that's become oversold with bullish money flow. This is the setup that we are looking for. I'm highlighting INVA in my note to clients today, and I wanted to highlight it here as well. Take a look at INVA as a potential long idea. Let's take a look at our sector tracker now, and I wanted to mix it up a little bit. I wanted to work in our relative rotation graphs because I think it's interesting to see where leadership is and where it's could be going or what could be playing out. So we're looking at weekly, 5 weeks over the past year, and you can see in the upper right-hand corner, XLV and XLK are your leadership. That's tech and healthcare, right? Financials had been leadership, but they've come under pressure of late. Now, Morgan Stanley's earnings are now out, and they beat expectations. We'll see if the financials can reverse course a little bit. Purely from a technical perspective, energy started to improve, but it's actually starting to tick back down here. And if you look at the lagging groups, these are the lagging groups, right? But we can see where there's potential near-term changes, right? We highlighted utilities a couple minutes ago. You see the Utes and the REITs had been badly lagging, but now they're starting to turn higher. Same with staples and discretionary. Now, materials continue to weaken, industrials continue to weaken. Comm services is a group that we've been talking about a lot. They are improving and heading in the right direction. So the relative rotation graph is a great tool because it shows you where leadership is, but it also shows you the changes that are taking place. We all know that REITs and utilities have been lagging, but what's interesting is they seem to be lagging less. So we'll try to find these changes on the margin. Speaking of energy, our industry in focus today, oil and gas equipment and services, which over the past 6 months has underperformed the S&P 500 by 20.5%. The power bar ratio hints at more to come. Remember, this measures future potential, and it's very weak. 14 bearish or very bearish stocks for 2 bullish or very bullish stocks. It's currently ranked at the bottom of the list, 21 of the 21 subsectors that we look at. And some of the indicative names there, names you certainly want to be avoiding. Drillquip, DRQ, very bearish rating. Core Labs, CLB, very bearish rating. And US Silica, SLCA, with a very bearish Jake and Power Gauge rating. So, right, it's just as important as knowing where the leadership is. We want to identify the areas of the market that you want to avoid as well. Don't get tempted to go bottom fishing, right? Energy's firmed up a little bit, but the fundamentals there are still not good. Take a look at this chart. This is XES, the Oilfield Services ETF that we use to track the group. It has a very bearish ETF power gauge rating. The trend is strong because it's above the trend line, and like this is what I was talking about, near-term stabilization, but the fundamentals just aren't there yet. Take a look at the rating. Take a look at the 14-2, bears to bulls. What about relative strength? This group's been an underperformer for more than a year, so market and model are in agreement as a bearish ETF is underperforming the market. Now, it is oversold in the near term, and money flow has been a bit mixed of late, but there's not enough here to get me excited about energy. If you're trying to outperform the market, if you're trying to be in the leading areas of the market, it's just as important to understand the areas of the market that you want to avoid. This is one of them, and it's playing out within the context of a sector that's underperforming, right? So energy just across the board continues to be an area that we want to avoid. Take a look at XLE, the Energy Select Sector SPDR Fund. It does have a neutral rating, and the trend is strong, right, above the trend line. But look at the underperformance. Group's been underperforming for the past year, and even when oil ticked up and the group tried to get going, we just couldn't get there, right? Continue to underperform, and the intensity of that underperformance is actually increasing of late. So despite the neutral rating, I'm still not ready. You know, if there was a group that had a neutral rating and it was really outperforming the market, I could say, okay, let's go hunting for ideas there. But this is a neutral rating that's badly underperforming the market, right? Take a look right in the groups here. Services is one of the groups. Bigger picture, sector level analysis continues to be an underperformer. We just want to continue to shy away from energy for now. I know people like to buy what's been beaten up, but to me, coming at it from a trend following discipline, I'd rather be focused on those areas of the market that are outperforming. I'd rather be focused on healthcare. Within healthcare, I want to be focused on pharma. We're going to take a look. I want to be focused on comm services. We looked at it earlier in this week. I want to be focused on technology. We've been pounding the table on that group. Now let's look at the charts now. It's Thursday. It's breadth day here at Chaikin Analytics, and breadth is constructive across time frames. And this is important because we like to see where there are near-term pockets of strength and weakness that could change bigger picture trends, right? Similar to what I showed you with the REITs and the utilities and the relative rotation graph. We want to look at breadth across time frames, and the bigger picture long-term trend is constructive. Take a look at the percentage of stocks above their 200-day moving average, up here over 80% after breaking out and moving higher with the broader market. That's confirmation. What about the intermediate term? Intermediate term time frame solid as well. 75% of stocks in the S&P 500 above their 50-day moving averages. If I took a look, and it's in my note, and if you signed up for the test drive yesterday, you would have gotten my note this morning. Remember, I highlighted that at the end of the show yesterday. If we look at the percentage of stocks above their 20-day moving average, well, that increased as well. It's at 68% this week, up from 59% last week. So across time frames, breadth remains constructive, and across all of these time frames, the current levels of the percentages of stocks above their moving averages line up with future strength for the market. So continue to focus on breadth. We'll wrap up breadth with the advanced decline line at the bottom of the chart. Take a look there, going out at all-time highs, similar to the S&P 500. So we have breadth confirmation across time frames. That leads us to believe that strength in the equity market can continue. Is it guaranteed to continue? No, but we're connecting the dots. We're taking a weight of the evidence approach. And when we look at breadth continues to support rising equity prices here in the U.S. And for equities as an asset class, I think it's interesting that global stocks are moving higher and potentially forming a relative base. Take a look at the ACWX, the ACWI ex-US ETF, right? We had this resistance level form, tested it once, pulled back, and now we've pushed through and continue to move higher as the fund trades above the rising 200-day moving average. All the while, momentum beginning to confirm. Take a look at the RSI here, a series of higher lows. It actually became overbought on one of these pushes higher. So momentum starting to confirm the price trend that we're seeing here in global equities. Now, on a relative basis, looking at the bottom of the chart, trying to stabilize a relative downtrend, right? For a long time, the U.S. market was the best game in town from an equity perspective. But now we're starting to see a little bit of a stabilization in global stocks broadly. So taking a look there, we're starting to see a base form in relative strength. Whether you want to start to overweight global markets, that's an allocation decision that you have to make. But from a breadth perspective, the fact that global stocks are moving higher lends further confirmation to the bullish trend in equities as an asset class. So that's just something that's interesting to me that we're focused on in our note today. And finally, I said we want to look at pharma as leadership. Check out XPH, the pharmaceutical ETF. Breaks through resistance, slight pullback, and now a move to new highs yesterday as the RSI is in bullish ranges, is now overbought, lending a momentum confirmation to the price trend. While at the same time, we have a breakout on a relative basis. We had a breakout, pull back to retest the breakout level, and now starting to move higher again. So pharma, part of that leading healthcare sector, is leadership at the industry level as a bullish ETF power gauge rating. 13 bullish stocks for 4 bearish stocks. That'll wrap us up for today. Head over to chaikinanalytics.com/today to sign up for the email. I will be back here with you tomorrow. Have a great Thursday, everyone.